Most people are completely overpaying for car insurance right now, and the reason is not what you think. Studies show that nearly 70% of drivers have never actually read their policy, and of those who have filed a claim, almost half say they were genuinely shocked by what was and was not covered. That is not a small number. That is the majority of drivers on the road today, paying hundreds or even thousands of dollars every single year for a product they fundamentally do not understand. In the next 10 minutes, we are going to change that. We will walk through exactly how car insurance works from the ground up, the math behind your premiums, the mechanics of a claim, and the layers of coverage that most people completely ignore. And by the end, you will understand the one counterintuitive truth about car insurance that the industry absolutely does not want to become common knowledge. Stay with us, because this one is genuinely worth your time. Car insurance has been around longer than most people realize. The very first auto insurance policy in the United States was issued in 1897 by Travelers Insurance to a man named Gilbert Loomis in Dayton, Ohio. He paid just $11.25 for coverage. At that point, there were fewer than 100 cars in the entire country, and the whole concept of insuring a vehicle was considered a strange novelty. Fast forward to today, and the American car insurance market is worth over $300 billion annually. It is one of the most profitable industries in the world, and it is built on a principle called risk pooling, which is the foundational concept you need to understand before anything else. Risk pooling is exactly what it sounds like. Instead of you bearing the full financial burden of a catastrophic accident on your own, thousands of drivers contribute small amounts into a shared fund. When something goes wrong for one of those drivers, the fund pays out. Insurance companies are essentially very sophisticated risk managers. They collect your premium, invest a portion of it, calculate the statistical likelihood that you will file a claim, and price everything to ensure the house always comes out ahead. That is not cynical, that is just the mathematical reality of how the business works. So how is your premium actually calculated? This is where things get genuinely interesting. Insurers use a process called actuarial modeling, a deeply complex form of statistical analysis that considers dozens of variables simultaneously. Your age, your driving history, your credit score in most states, your zip code, the make and model of your vehicle, how many miles you drive per year, and even your occupation all factor into the final number. A 22-year-old male driving a sports car in a dense urban area might pay 4 or 5 times more than a 45-year-old woman driving a sedan in a rural county, even if their actual driving records are identical. The insurer is not judging you personally. They are placing you into a statistical risk category and pricing accordingly. Your credit score deserves special attention here. In 47 out of 50 states, insurers are legally allowed to use your credit-based insurance score as a pricing factor. This is separate from your regular credit score, but it is derived from similar data. Studies by the Federal Trade Commission have found that credit-based insurance scores are genuinely predictive of claim frequency. People with lower scores statistically file more claims. Whether that practice is fair is a separate debate entirely, but it is the reality, and it can move your premium by hundreds of dollars per year without you ever knowing why. Now let us talk about the actual layers of coverage, because this is where most policyholders are completely lost. Liability coverage is the foundation. It is required by law in nearly every state, and it pays for damage you cause to other people, both their property and their medical bills. It does not cover you or your vehicle at all. When you see a policy listed as 100/300/100, those numbers represent $100,000 per person for bodily injury, $300,000 per accident for bodily injury, and $100,000 for property damage. Many drivers carry state minimums, which in some states can be as low as October 20th, 10. In today's world, a single serious accident can easily exceed those limits, and everything beyond the policy cap comes directly out of your pocket. Collision coverage pays to repair or replace your vehicle after an accident regardless of fault. Comprehensive coverage handles everything that is not a collision: theft, vandalism, flood, hail, a deer running into the road. These two coverages together are often called full coverage, though the term is not actually an industry standard and can be misleading. Your deductible on these coverages is the amount you pay out of pocket before the insurance kicks in. A higher deductible means a lower premium, but it also means more financial exposure when something actually happens. Here is what nobody talks about, and this is the part that genuinely surprises people. Gap insurance. If you financed your vehicle, there is a window of time, sometimes as long as 3 years, where you owe more on the loan than the car is actually worth. If your vehicle is totaled during that window, standard insurance only pays the actual cash value of the car, not what you owe the bank. Gap insurance covers the difference. Dealers will happily sell it to you at a significant markup, but your own insurer or even your bank will typically offer the same product for a fraction of the price. Uninsured and underinsured motorist coverage is another critical piece that millions of drivers skip entirely. According to the Insurance Research Council, roughly 1 in 8 drivers on American roads has no insurance at all. In some states like Michigan and Florida, that number climbs closer to 1 in 5. If an uninsured driver causes an accident and you are not carrying this coverage, you are left to pursue that driver personally in civil court, which is both expensive and often fruitless. This coverage is one of the highest value protections you can buy relative to its cost. Medical payments coverage and personal injury protection, often called MedPay and PIP, cover your own medical expenses after an accident regardless of fault. PIP is required in no-fault states and often covers lost wages and rehabilitation costs as well. In states where it is optional, many drivers skip it assuming their health insurance will handle it. But health insurance can come with its own deductibles, copays, and coverage gaps, making PIP a genuinely useful safety net. Now let us talk about the claims process, because the gap between expectation and reality here is enormous. When you file a claim, the insurer assigns an adjuster who is working on behalf of the insurance company, not on your behalf. Their job is to assess the claim accurately, but they also operate within systems that are designed to move quickly and efficiently, which does not always align with getting you the maximum payout. You are legally allowed to hire a public adjuster to represent your interests, and for large or complex claims, that can make a meaningful financial difference. The adjuster will assess actual cash value using depreciation schedules that can significantly reduce the payout on older vehicles. Understanding that depreciation is being applied to your claim, and knowing that you can negotiate the settlement, is information most policyholders simply do not have. Here is the broader picture. The car insurance industry spends more on advertising than almost any other sector in the American economy. 15 minutes could save you 15%, you know the jingle. That relentless messaging is effective because it obscures complexity behind simplicity. The real competitive advantage for any driver is not switching companies on a whim, it is understanding your actual risk exposure, building a policy that addresses that exposure precisely, and shopping your rates with full knowledge of what you are comparing. Bundling home and auto policies, maintaining a clean driving record, completing defensive driving courses, and adjusting your deductibles strategically are all levers that genuinely work. Car insurance is not a commodity. Before you go, if you learned something valuable today, hit that like button right now. Subscribe to AutoVision Daily for a brand new video every single day. We will see you in the next one.